The studio, and Peter, just let us know what's unfolding there on the screen.
Well, Nick, a few seconds ago, as predicted, the Reserve Bank Board cut the cash rate to 3%. So that's as most economists predicted, and after all, the financial markets had been factoring in a 93% chance that this would happen. So down by 25 basis points to 3%. As expected.
In line with expectations, they obviously have chosen not to make a more aggressive cut.
I think that one of the very big considerations is the raft of quite weak data that we've seen just in the last few days. Retail sales for October coming in flatlined at 0.0%. You don't see that very often. We saw that company profits were down yesterday. We already knew that commodity prices were weakening, and the Reserve Bank had made the point again just recently that the resources boom would peak much earlier than expected. Building approvals today down by 7.6%. Expectations are on Wednesday, tomorrow, in the national accounts, GDP may fall below 3%, annualised to about 2.7%. And of course, the very high Australian dollar. These are all factors that the Reserve Bank would have taken into account today to take the cash rate to 3%.
And of course, December cuts always get characterised as a Christmas present.
It may well be a Christmas present, depending on how you're looking at it, but really the Reserve Bank is looking over what the challenges are going to be in 2013, next year, what is going to be happening to the Australian economy. They've clearly judged that they need to move earlier rather than later. But remember, on Melbourne Cup Day last month, there was a lot of speculation they would move then, and they didn't, because they were concerned about inflation. And once again, inflation, while it's still low and at the bottom end of the 2 to 3% target band, they want to make sure inflation doesn't get out of control. They're clearly much more comforted about inflation. A private gauge from TD Securities showed inflation last month fell by 0.1%, so that would have given them a bit of cause. So they've decided that they need to act now rather than leaving it till February, because the Reserve Bank Board doesn't meet in January. They have a month off. So starting the new year in a much better place. Of course, with speculation that there might be another cut in February or January, depending on how the economy is going.
How much room does the RBA have to make further cuts to rates?
They've got a lot more room than other central banks around the world. The US Federal Reserve, close to zero, very close to zero, and the European Central Bank and also the Bank of England. You recall that the Reserve Bank at the end of 2009, after rates were at 3% the last time, gradually started moving rates back up to 4.75%. So they've had the capacity to cut rates, where the other big central banks around the world have had little or no capacity, which is why they're printing money at the moment. So when you look at it, Australia is a AAA rated nation, low interest rates, lower than they were a few minutes ago. It's good news, and also the economy is growing at close to 3%, which is something that other nations, developed nations around the world, would be watching with envy.
And as you're pointing to, their interest rates are one of the few levers that the central bankers have over the economy. Yes. So Australia remains in a good position that our RBA can still make further adjustments.
But it is interesting, despite that 25 basis point cut, the Australian dollar has actually gone higher. Now
that's the reaction since the announcement was made.
It had been speculated before the announcement that the Australian dollar perhaps might rise unless there was something more than a 25 basis point cut, and so that's actually happening now. Before the rates decision, the Australian dollar was buying 104.21 US cents. Now it's up at 104.4. So perhaps financial markets don't see that as enough, and that perhaps a bigger rate cut, and certainly retailers like Solomon Lew from the Premier Investment Group earlier today was saying that a much bigger rate cut was warranted to push that high Australian dollar down.
And of course the other big question is how much and when will the banks pass on to their customers?
Well, we know that at the moment that the cost of sourcing money by banks on global markets has plateaued somewhat, perhaps even fallen back. But the big factor that banks have to worry about at the moment is funding deposits. Banks worry as much about depositors now as they do about more residential and business borrowers, and there's a deposits war underway for deposits. So banks will be under a lot of pressure to find the money to keep paying those interest rates of 4 or 5% to keep the money with them.
Yeah, obviously people with money on deposit aren't going to be happy by rates falling, but it's probably people with mortgages and potential home buyers who have a lot more influence as a group over the economy as a whole.
Well, certainly anyone with a very big mortgage or even a small mortgage would be very happy to see the cash rate cut. Of course, it depends how much the commercial banks pass on, but as we'll be hearing very, very shortly, I would imagine, from the Treasurer, the banks will be under a lot of pressure to pass the lot on in full. We'll just have to wait to see how much and who moves first.
Okay, Peter Ryan, thanks for coming in again and keeping an eye on that interest rate move and giving us that analysis.